right, guys. Good um, early afternoon on a Saturday. I hope your second test went well, or it's going well if you're still taking it right now. Today we're gonna talk about Chapter 11. Okay, Chapter 11 is the foreign exchange, and this is, like I mentioned in class earlier this week, the backbone of the rest of our semester for international finance. So there are a lot of very important concepts in this chapter, and quite a few different formulas that you can use to calculate things. So make sure you um, read it carefully, view this video, and carefully study and digest all this information, because it will be um, what we build upon for the rest of the semester. Okay. Now, excuse me. I will roughly follow the summary questions that you have access to, but I will only hit the highlights and the hard points, so I'll still make sure you read the chapter to get the rest of it. Okay. Now, the foreign exchange market, okay, is just an organizational setting for individuals, businesses, and governments and banks to buy and sell foreign currencies and other debt instruments. Okay. Now, it is the largest and most liquid market in the world. Okay. And I haven't read in your book to carefully in the beginning to remember the specific number, but if I remember correctly, your book points out that this is a market that over $5 trillion of currencies are traded on a daily basis, right? So it's a very large market, and it's dominated by just 4 or 5 major currencies, right? U.S. dollars, the U.S. dollar, the euro, the Japanese yen, the British pound, and as a rising star, the Chinese yuan, right? Slowly. Okay. Now, some basics about the foreign exchange market. There are a number of exchanges throughout the world. The largest ones are in New York, London, and Tokyo. But if you count all the other ones, like in Sydney and Singapore and Hong Kong, those places, this is a market that only closes 1 hour out of the day, right? So by the time that um, the Asian markets close, is pretty much time for New York to open, or San Francisco to open, or New York, right? New York to open. So anyway, so there's this market, throughout the day, 23 hours out of the day, there's always at least one market that's open where people and businesses can exchange foreign currencies. Okay. Now, there are 3 levels of functions for the foreign exchange market. Okay, the first is that you have transactions between commercial banks and commercial customers. What we mean by that is you have, let's say, maybe Melaleuca, right, just made a deal with some British buyers, and then they are about to receive 5 million pounds of payment that they need to convert into dollars, right? Because they want the good old green dollars, so they can make a deal with, Bank of America and say, hey, we want to exchange 5 million pounds into dollars, right? So that would be a transaction between a commercial bank and a commercial customer. Okay, that's the first function. The second function is what we call domestic interbank market. That's conducted through brokers. So that is when banks within a country try to make deals concerning foreign exchange, right? So for example, let's say if Melaleuca did not go to Bank of America, but they went to Zions Bank, or maybe the Idaho Credit Union, Central Idaho Central Credit Union, right? And said, hey, we have $5 million, 5 million pounds coming in. We want to exchange to dollars, and maybe let's say that ICCU does not have enough dollars to satisfy that transaction, then they can uh, approach, let's say, Citibank and say, hey, Citi, we know you're a huge player in the foreign exchange market, and we're about to receive 5 million pounds that we need to convert into dollars for a client. Can you guys help us with that, right? Do you have resources? And so Citi can work with ICCU to make this transaction happen. That would be an interbank transaction. Okay. The third level of function is when you have active trading in foreign exchange with banks overseas, right? So that's when Citibank makes a deal with, Deutsche Bank in Germany, and then they make some kind of transaction happen, right? So it's banks in different countries making trades. Okay, so those are the three types of, or three levels of function in the foreign exchange market. Okay, now in terms of the different types of foreign exchange transactions, okay, the first one is called a spot. Oh, okay, 1 second, I don't know. Oh, you know what? I just restarted my iPad, so my Apple Pencil is no longer linked to my iPad. Give me a second. I'm gonna pause the video, link it, and come back. All right, I'm back. So yeah, right before this video, updated my um, I updated my software on my iPad, so it killed the Apple Pencil. Okay, all right. Sorry about that. Okay, so the three types of foreign exchange transactions. Okay, the first one is called a spot transaction. Okay, a spot transaction is foreign exchange bought and sold for delivery immediately. Okay, so if you need to, get some foreign currencies right away, and then you go to a bank that does offers the service, and you make a transaction, and that is called a. I mean, you exchange your money right now from dollars to, let's say, Japanese yen, because you want to go to Japan this summer. Okay, and that's called a spot transaction. It's happening right on the spot. Okay, and it doesn't happen a whole lot, but this is one type of transaction there is. Okay, the second type of transaction is more common. This is called a forward transaction. A forward transaction is when somebody signs a contract with usually a bank and says, okay, we will agree on the terms now, and then in a future, on a future date, we will make a transaction happen. Right? This is more common because for businesses, usually they sign a contract and the payment is not executed until the contract is fulfilled, right? So for example, maybe Melaleuca just made a 5 million pound sale to England, but their English buyers will not pay them until they deliver their products. Okay, so let's say it takes them 6 months to make this batch of production products happen. So then they will expect a payment 6 months from now. Now, one big risk involved with this is, well, you don't know what's going to happen in 6 months with the exchange rate, right? So if, let's say, during this 6 months, okay, and the British pounds depreciates, okay, and then that means the 5 million pound payment they're going to receive could measure a lot less than they thought, right? So maybe they thought 5 million pounds would have converted to $10 million, but in 6 months, if something happens and 5 million pounds are only worth $5 million, then for Melaleuca it would be a huge loss. So what companies usually do is then once they know they can expect this payment to come, they can go to a bank. Let's say they go to Bank of America again and say, hey, Bank of America, in 6 months, I am going to receive 5 million pounds and I want to convert into dollars. And how about we make a deal right now and we will sign a contract right now saying that 5 million pounds will convert to $10 million in 6 months. And then if the bank agrees that this is not a non-reasonable price, they can then strike up a contract, and that's called a forward transaction. They specify the terms today and agree to make that transaction happen in the future at a specifically agreed upon price now or exchange rate now. So that way, Melaleuca can protect itself knowing exactly how many dollars they're going to receive when those 5 million pounds come in, right? So that's called a forward contract, okay? And now the third type, okay, is called a currency swap. Okay, a currency swap is when you convert one currency to another at one point of time, and then in a future date, you're going to convert it back. Okay, this happens when you have some kind of investment in a foreign country that you need, the foreign currency to make the investment happen now, but you know exactly when you're going to receive your payment for your investment, and you need to convert that payment back into your own currency, right? So for example, let's say that you decided to buy some bonds in Switzerland, and these bonds mature in 6 months, right? So that means right now you need Swiss francs to make the purchase because the bond issuers in Switzerland won't accept your good old green dollars. They want their Swiss francs. So you need to exchange, let's say, for $10 million worth of Swiss francs. Well, 6 months from now, the bonds will mature, so you will get your $10 million of worth of francs back with interest, at which point you don't want to hold francs, you want to hold the good old green dollars, so you need to then convert those francs back to dollars for yourself. So what you can do is then you can go approach a bank and say, hey, Zions Bank, how about we make a deal right now? I'm going to exchange $10 million to Swiss francs, and then 6 months from now, I will convert those francs back into dollars, and you specify the exchange rates of the purchase now and the sale of francs 6 months from now, and that's called a currency swap, right? That way, again, you know exactly how much you're spending now and exactly how much you can get back based on the exchange rates and also the interest rate you might earn. Okay, so currency swaps are very common when you know you are going to need need to convert to one currency and then convert that currency back in a future date. Okay, so that is the three different types of transactions. Okay, now the swaps are actually the biggest uh, the biggest chunk of the currency foreign exchange market, right? And then other types are a little bit less common. Okay, now let's talk about the interbank trading in a little bit more detail. Okay, so because that's how most banks operate. Only a very few banks deal with foreign counterparts directly. Most banks in America, for example, deal with those few banks that get sell and buy currencies with foreigners, and then the rest of the vast majority of banks will just do interbank trading with those few large banks that do international transactions. Okay, so when a bank either purchases or sells less than 1 million currency units of some kind of currency, they call that a retail transaction. Okay, and if it's more than 1 million, they usually call that a wholesale transaction. Okay, and now when it comes to foreign exchange players, okay, the U.S. has just a few banks that participate in it. Right, the biggest in the whole world is Citibank, and they take about 13% of the market. So if you do the math, $5 trillion a day, 13% of that is an enormous amount of money that Citibank puts into the foreign exchange market, right? JP Morgan is also very big, and the Bank of America. Goldman Sachs, these are the big players in the foreign exchange market from America, and including also Morgan Stanley, which is only at 3 point something percent, but that's again $5 trillion a day of a market, so 3% of that is still huge. So other small banks like Zions Bank, Wells Fargo, U.S. Bank, and these guys just trade with the big players, usually do interbank trading. Okay, now When banks trade currencies, okay, you might say, well, why would they do that? The reason, of course, is that they make money. Okay, how they make money is that each bank has a few different rates or two different rates on each currency. Okay, for each currency they're willing to trade, they have what's called a bid rate, okay, and a offer rate. Okay, the bid rate is the price the bank is willing to pay for a unit of foreign currency. Okay, so that's what banks are willing to pay. Okay, so if it's Chinese yuan, we're talking about a bid rate on the yuan is how much the bank is willing to pay. Let's say maybe they're willing to pay, so let's see, $1 for, you know, 7.2 yuan. Okay, so that's what they're willing to pay. Okay, but the offer rate is how much or the price the banks are willing to sell their currency. Okay, so if they're willing to pay, $1 for 7.2 yuan, and when they sell yuan, okay, then maybe they say, okay, you're gonna have to pay me. Well, let's see. Maybe that's not a good way to look at it. So, yeah, yuan is hard because it's hard to convert that into a bigger number for you to see. Let's do a different one. Let's say maybe it's a British pounds, right? So let's say the banks are willing to pay, okay, $1.50 per pound, okay. Okay, that's the bid rate. And then the offer rate, when they sell, they say, hey, you need to pay me $1.80 per pound. Okay, so that way you can see they will buy pound at a lower rate and then sell pound at a higher rate. So the difference between your offer rate, okay, minus your bid rate, this is called the spread. Okay, and the spread is how much the bank makes, right? That's why they're willing to participate in the foreign exchange market. Essentially, they buy foreign currencies at a lower exchange rate and then they sell it at a higher one, so they make the difference, the spread as their profit. Okay. Now, let's look at how to read the exchange rate, right? The exchange rate is, we said, the price of one currency measured in another. So there are two ways of looking at a exchange rate. One is, let's say, if we are looking from the US perspective, one way you can look at it is how many dollars it takes to buy one British pound. Or you can look at how many British pounds it takes to buy $1. Okay. Now, the more common one is this perspective, okay, where we say how many domestic, so units, how many units of domestic currency it takes to buy one foreign, okay? And that is the traditional way of measuring exchange rates. Now, this is important because depending on which perspective you look at it, when we say your exchange rate went up, okay, it can mean differently, and it can mean different things, right? So, for example, the traditional way from the US perspective is to look at how many US dollars it takes to buy one foreign currency, right? So if the exchange rate goes from $1.50 per pound to $1.80 per pound, okay, has the dollar appreciated or depreciated? Okay, think about that for a second. This is something that often is confusing to students, right? So this is when we say that the exchange rate has increased, right? Because it went from $1.50 to $1.80. But even though we say it's an increase in your exchange rate, but does that mean the dollar appreciated? The answer is no, right? Because now the dollar actually, in this case, the dollar depreciated, right? Because now it takes more dollars to buy one foreign currency. It used to take $1.50 to buy 1 pound. Now you have to take $1.80 to buy the same pound. So the dollar is worth less now. So when you use the traditional, the most common way of looking at exchange rates by looking at units of domestic currency per unit of foreign, then when you have an increase in the exchange rate, that means your currency has depreciated. And when you have a decrease in your exchange rate, that's when your currency appreciated. Okay, so keep that in mind, and that can be confusing sometimes. Okay. All right. Now, of course, okay, currency depreciation, and appreciation, we just talked about how it just means more. I mean, whether it takes more units of a nation's currency to buy one foreign or less. Okay. However, when it comes to exchange rates, okay, there are about 200 something different currencies in the world. Not all of them have a direct exchange rate against each other because many small, tiny currencies are not traded directly. So in that case, okay, you don't have a exchange rate, but rather you might say, well, in that case, how can they figure out the value of different small currencies? That is when we use what's called a cross, okay, exchange rate. Okay, a cross exchange rate is when you compare two currencies that do not trade directly to a common third currency. Usually it's the dollar, right? So let's say if the Mexican pesos, you're trying to figure out the value of pesos versus the value of Swiss francs. Those two are probably not directly traded and don't have a direct exchange rate. But you know that for pesos, okay, let's say it is, okay, 5 cents per peso, okay? And on the other hand, for francs, it is, let's say, it's about, let's say, $1.20 per Swiss franc. Okay, now, if you want to know, okay, what is the exchange rate between pesos and franc, well, then what you do is you take the value of your, the dollar value of your Swiss franc divided by the dollar value of your Mexican peso, okay, which is $1.20, right, over 5 cents, okay, and then, whoops, not $1.25, sorry, $1.20, okay, and that gives you 24, and that means it takes 24 pesos per franc, okay, so that is the cross exchange rate between Swiss francs and pesos, okay, and so that's how you figure it out. You use the ratio between the two currencies against the same common currency, usually the US dollar, to figure out, okay, what the value ratio is between these two odd smaller currencies. Okay, all right, hope that makes sense. Okay, now the next thing we want to talk about really quick is the difference between the forward and the futures market. Okay, so we already talked about what the forward market is. That's the example I gave you about Melaleuca making a contract with Bank of America, in 6 months where they will exchange for 5 million pounds. But a very similar type of transaction also exists in the futures market where you can actually have currency futures. Okay, now these two sound similar. So what's the difference, right? Because when we described the forward market, some of you who are familiar with futures market might have thought, hey, that just sounds like the futures market. Now your book has a nice table showing you or summarizing the difference of these two markets in table 11.4. You can read in great detail about that, but the major differences are, first of all, who issues these contracts, right? So the forward contracts, like the Melaleuca example, are issued by commercial banks, okay? The futures contracts are issued by the International Monetary Market in the US and in foreign countries, they have similar entities that issue these contracts, not by commercial banks. Okay, and another difference is, a forward contract can be for any size of currency at any length of time. Okay, so you can do, $123,565.69, and I want this contract to execute in, exactly 35 and a half days, right? You can have some very specific and odd numbers in this forward contract, but futures contracts are more rigid. They're usually measured in standard rounded amounts like 1 million, 2 million, 10 million, right? These rounded, well-rounded whole quantities, and then they execute in very rigid time window, right? They mature in 30 days, 60 days, 6 months, 9 months. So there's no like 36 and a half days type of futures contract, right? So these are some of the differences. Again, you can read more about it, but I wanted to make sure you understand the difference. Okay, so forward contracts also are usually used by companies to satisfy their needs for fulfilling a contract with their buyers or sellers, but futures contract sometimes are used for profits, right? So anyway, so that's some difference there. Okay. All right. Let's see. What else do I want to look at? Okay. Now to read the futures market, okay, you also have the table 11.5 to tell you how to read the futures market. What is the open price, the high, the low, the settle price, right? So I'm not going to go into great details. You can read about it yourself. Okay. All right. Now let's talk about currency options. Okay, foreign currency options. Okay, this is another type of approach companies can take, or even individuals can take in the foreign exchange market. Okay, an option is an agreement between the holder, which is the buyer of this option, this contract, and the writer, which is the seller of this contract. Okay, so it's an agreement, okay, between holder, okay, who are the buyers, oops, and the writer, who's the seller of, okay, of the contract. Okay, that's what an option is. Okay, now the holder has the right, but not the obligation to buy or sell these currencies at any time through the specified date. The writer, which is the seller of the contract, has the obligation to fulfill that transaction. Okay, what I mean by that is, let's say I'm the holder of a contract and you work for Bank of America, and so you're the writer. We come to an option agreement where we say, okay, I, Martin Ma, reserve the right to buy 2 million pounds from you within the next 6 months at this price, okay, or at this exchange rate. Okay, so what happens is then, if I have a need to actually buy those 2 million pounds with you, I can call on you anytime during the 6 months and say, hey, I need those 2 million pounds transferred into my account right now, and you have to do it. But if I decide I'm not going to actually go through with it, then you cannot force me to buy the pounds from you. Okay. And similarly, we can sign a contract where I say, okay, I reserve the option to sell you 2 million pounds anytime given the next year at this specified exchange rate. And if I feel like I need to sell it, you have to buy it from me. But if I don't want to sell it, then you can't make me sell it to you because I'm the holder, you're the writer. Okay. Now, you might say, well, why would anybody want to have this kind of an option? Well, remember we said Melaleuca signed a contract and expects to have £5 million deposited in their account 6 months from now, but they worry about what if the pound depreciates and makes their payment smaller than they expect, right? But on the other hand, what if the pound appreciates and they could actually earn more money, right? So by signing a forward contract, they lock down the exchange rate, but they lose the possibility of gaining more money if the pound actually appreciates. So in that case, what they can do is to sign a currency option with Bank of America and says, hey, you know what? We reserve the right to exchange £5 million with you at this exchange rate in the next 6 months. And then they can just wait and see, right? Because when they get paid, if the exchange rate is in their favor, they can just do a spot transaction and not go through with their option contract. But if somehow the pound did depreciate, then they can always go back to their currency option contract and say, hey, we agreed on this this more favorable exchange rate, and you need to deliver the dollars to me now, right? So this way, companies can protect themselves without the commitment of going through with a contract in case the spot rate actually is better in the future than they realize or than the contract they signed, right? So now the option holders has the right to either buy or sell the agreed upon amount of foreign currency at the prearranged price within the time period. And when they do that, okay, it's called the call option. When you call on your option, that means you are asking the writer to fulfill their agreement, okay? And I should say, well, specifically, when you have the call option, that's when you have the right to buy foreign currencies at your specified price. Then when you call, like when you ask the writer to let you sell, that means you're in a put option, okay? And the price that this transaction happens is called the strike price. Now you might say, well, why would banks ever put themselves in this situation where they have to fulfill a contract, and even though that contract could be not in their favor, right? Because if, let's say, Bank of America signed a contract and to pay the $2 per pound to Melaleuca, but then during this period of time, okay, let's say now the exchange rate happened where the dollar appreciated and the pound depreciated, and by the time the Melaleuca asked them to fulfill the contract, the exchange rate actually is $1.50 per pound. So they are actually paying more than the market rate, right? So why would they put themselves into that situation? Well, the answer is that, when you sign a contract like this, then the banks usually ask for a premium, which is a guaranteed fee you have to pay them whether you go through with your contract or not. Okay, so that fee can be the guaranteed profit for the bank. Now they know there might be a risk that they lose money, but they're counting on the fact that the exchange rate might not fluctuate more than the fee they charge. Plus, if you don't actually call your option or put your option, then they will collect the fee for doing nothing, right? The fee is usually about 5% if I remember correctly. So it's a pretty healthy, buffer, right? They can have, and so that's why most banks are willing to do currency options type of contracts. Okay, all right. Okay, now again, if you have questions, make sure you write them down. Okay, and next we want to talk about the exchange rate determination. Right? How are exchange rate determined? Well, it turns out, okay, the exchange rate is determined by the supply and demand of the foreign currency. Right? So here, let's say we're looking at the exchange rate of dollar against the euros. So remember, this is the foreign exchange market. So we measure the quantity of the foreign currency in this case, which is the euros. Okay, the demand of euros is represents all of debit items on the US's BOP balance, right? Because whenever we say we have a debit item, that means we are paying foreigners, so we need foreign currencies to do so. So that's when we demand foreign currencies, right? And specifically when it comes to the euro, then this is when we demand anything from the eurozone. Then when we buy anything from the eurozone, whether it's goods and services or capital or assets or patent, whatever it is, we're demanding the euro. Okay, now the supply of the euro, okay, that comes from any debit items, right? So, any credit items in our BOP account. That's when anybody in the eurozone wants to buy American, right? Then they are offering their euros for sale, so they're supplying their euros to the market. Okay, together, okay, they determine the equilibrium exchange rate. So maybe it's $1.20 per euro, okay, and then the quantity, right? So maybe it's 3 trillion euros traded a day or something, right? So now, as you can see, when there's a change, okay, in the exchange rate, first of all, we said if the exchange rate increases in this direction, that's when you have depreciation of your dollar, right? Okay, so depreciation of the dollar, because any higher than 1.2 means it takes more dollars to buy a euro now. Any decrease in the exchange rate, that's when you have appreciation, okay, of the dollar. Okay. Now, how do these changes happen? Well, that depends on a change in this market, right? So let's say somehow, let's say the first vaccine that's effective in protecting us from the coronavirus comes out of France, right? France definitely is putting a lot of resources into making vaccines, and they have made some promising breakthroughs. And let's say they're the first ones that came up with a vaccine that actually works very well. So that would, all of a sudden, Americans want to buy that vaccine, so that would increase the demand for euros. As a result, okay, let's say your exchange rate goes to $1.50 per euro. So that means the dollar has depreciated, right? Because now it takes more dollars to buy the same euro. Then we're going to trade more euros, maybe go from $3 to $4 trillion. Okay, so that's so any change in the balance of payments, demand, and supply will change your foreign exchange rate of your currency against something else. Okay. Excuse me. So anyway, I hope that makes sense. It's just a supply and demand model, again, applied to the foreign currency as the commodity. Okay. All right. Now, when it comes to the value of the dollar changing, okay, if you don't understand how the economy works and how international trade works, then you can fall into the common fallacy where people think that we should really want the dollar to always appreciate, right? And somehow that triggers people's national pride, and then their patriotism, and then you say, hey, a strong dollar means America is strong. But now, hopefully, after our discussion just now, you understand, okay, an appreciating dollar does not benefit everybody, right? So U.S. consumers will like it because foreign goods will be relatively cheaper, and um, that that can in turn also benefit consumers in the sense where inflation rate will be low because foreign price level will be decreasing in the US, okay? And so we benefit as consumers, but that endangers our exporting firms, right? Because when they sell to other countries, an appreciating dollar means even if their dollar price doesn't change for their products, the foreign price for their products will change and will increase, and so they'll face a decreased quantity demanded. Okay. On the other hand, a weakening or depreciating dollar will hurt the consumers because foreign products will seem more expensive, but it will benefit American exporters because, well, American products will seem relatively cheaper to foreigners, right? So it's never, everybody wins or everybody loses kind of situation. Okay, so keep that in mind. Okay, all right. Now the next question is, well, how do we determine if your currency is actually appreciated or depreciated? Because you might say, yeah, against the euro, the dollar has definitely appreciated. But remember, the dollar is traded against almost all other currencies, right? What if the dollar is appreciating against the euro, but depreciating against the Chinese yuan, and then doing, appreciating against the pound, but depreciating against the Japanese yen? So how do we figure out whether the dollar is appreciating or depreciating overall? Well, the answer is that we use what's called an exchange rate index, and we look at something called the effective exchange rate. Another name is the trade weighted dollar value. So what we do is we look at the trade volumes of the US against all those other currencies we mentioned and create a weighted average of what's happened to the dollar, right? So if the dollar, let's say, appreciated by 30% against the euro, but the euro is only 10% of the trade, accounts 10% of the trade with the US, then that means the net effect on the dollar value is only 30% times 10% of trade volume, so it's a 3% increase. And on the other hand, if the dollar depreciates against the yuan, and China actually accounts for 50% of our trade volume, and the dollar depreciated by 10%. So that means then it's 10% times 50%, that's a 5% depreciation. So the 3% appreciation against the euro and plus the 5% depreciation against the Chinese yuan makes the dollar still depreciates by 2%, right? So anyway, so when we do that to all currencies that we look at, all the major currencies that we trade, we do international trade with, then we can come up with the effective exchange rate to figure out overall did the dollar increase in value or decrease in value. Okay, and okay, another concept is nominal exchange rate versus real exchange rate. Okay, so the reason for we talk about that is because, well, exchange rate measures the difference or the two relative values of two currencies against each other, right? Excuse me. But what affects the value of a currency is not just the volumes of trade, triggered triggered the change of currencies, but it can also come from domestic inflation, right? If we have really bad inflation domestically, that's going to make the dollar worth less, and which will be reflected on the exchange rate side as well. So that leads to the idea of real exchange rate. Okay, so real exchange rate is when you look at what happened to the currency of your dollar after you get rid of any impact from inflation, right? So there's a formula, your real exchange rate, okay, that equals your nominal exchange rate, which is what we see what we see as the exchange rate reported. You know, for example, the Wall Street Journal takes pages every day to report the exchange rate, but now, of course, you know, Google is much easier. Okay, times the foreign price level versus the domestic price level. Okay, so let's look at an example. Okay, let's say that you know, in 2018, okay, maybe let's say it took 90 cents per euro, okay, in 2019, okay, now it's 80 cents per euro, okay. So if we only look at these two rates, these are our nominal exchange rates, okay. You might say, hey, look at that, okay, the dollar has changed by 90 cents minus 80 cents divided by 80, or sorry, divided by 80 cents because, sorry, 90 cents because that's the previous value, right? And that is an 11% appreciation of the dollar against the euro, right? But let's say, you know, in 2018, let's assume that's the base year for both Europe and the US. So the CPI for US is 100 in 2018, and CPI of the EU is also 100. Okay. Now in 2009, the CPI of the US, let's say, is I don't know, how much should we make it? Let's say in the US, it's you know, 108. Okay, and CPI of the EU is 102. Okay, so there's more inflation in the U.S. than the European Union. If that's the case, okay, your real exchange rate, okay, according to our formula there, is your nominal exchange rate in 2019. So this is 2019, right? So 0.8 dollars per euro times, okay, the price level of foreign, okay, 102 divided by the domestic price of 108, okay, that will give you roughly 75.6 cents per euro, okay. So that's your real exchange rate. Now, if you were to calculate the change in our exchange rate, it becomes 90 cents per euro minus 0.756 cents per euro divided by 90 times, well, yeah, if you want to time 100, right, that gives you 16% roughly, right? So in this case, the dollar appreciation is higher than what we previously thought by looking at just the nominal rate, right? The nominal rate, let's change this a little bit, right? So keep it consistent, okay? So if we only look at the nominal rate, then the dollar appreciated by 11%. But once we factor in the fact that there's higher inflation in the U.S. and the dollar still appreciated against the euro, in that case, then we know the dollar actually appreciated by 16%. Okay, so that's what real exchange rate gives, because it can help you look at the real change in the value of your currency against another currency after you take into a consideration of the inflation rates in both countries. Okay, all right. Okay, so now let's talk about arbitrage. Okay, so arbitrage, Okay. Arbitrage is simultaneous purchase and sale of a currency in different foreign exchange markets in order to make a profit. Okay. So what I mean by that is, well, you know, if um, if you look at the different major foreign exchange markets throughout the world, okay, they all have their own exchange rates, between different currencies. Most of the time, they're the same or very similar. But even if there's a slight difference, okay, that means then you can profit by exploiting that difference and make money, right? For example, okay, so let's say that in New York, for example, see in New York, okay, and let's say currently, okay, you have £1 exchanges for $2, okay. In London, okay, you see that £1 exchanges for $2.1. Okay. Now, what do you do to take advantage of this particular situation? Okay. Well, now, what you want to do, okay, is to purchase the pounds in New York because the pounds are cheaper. It only takes $2 to buy. So let's say if you have $2 million, okay, sitting around, what you want to do is to buy $2 million worth of pounds in New York. And that will give you 1 million pounds, right? And simultaneously, so in the same time, you sell, okay, 1 million pounds in London. And that will give you $2.1 million. So if you do this, that means as soon as you're done with these transactions, you have turned your 2 million initial amount into $2.1 million in your account, immediately, right? Because you need to do these simultaneously because these exchange rates change very rapidly, oftentimes several times a minute, right? So these only last usually, a few seconds or by the minute. So you have to be very quick in executing these transactions. Nowadays, we have computer programs that search all the major markets to spot any difference in these currencies and then execute transactions like this. Or if it's too large, then they need a human confirmation, but you can just look at it really quick and then click yes, and then that transaction goes through. So you can make money by exploiting the differences in exchange rates in two different markets, and that's called arbitrage. Okay, but the purchase in New York of pounds and the sale of pounds in London have to happen simultaneously. Otherwise, the exchange rates can change and that gap will be closed. Because as you buy, as in this example, as people buy more pounds in New York, the pound is going to appreciate in New York, right? And when people sell pounds in London, that means pounds will depreciate in London. So that means, okay, this rate is going to increase and that rate is going to decrease, so that difference is going to close fairly quickly. Okay, so this is how you make money with arbitrage, and this is called a two-point arbitrage. Okay, you can have multiple point arbitrage. So let's look at a three-point arbitrage example, and I'll just use what's in your book. Okay, so and you can even go more than three, but that's very difficult to spot and calculate and figure out, right? So let's say that in New York, okay, currently, okay, you have £1 exchanges for $1.50 in New York. Okay. In the meantime, in Geneva, okay, and you have £1 for 4 francs. Okay. And then in London, at the same time, you spot 1 franc for $50. I mean, sorry, 50 cents, not $50, $0.5. Okay. So if this is the current situation, you spot these 3 exchange rates, and let's assume that you are very good at this and you can quickly do the math in your head, you realize, hey, these are not the same, right? So you can then exploit this by doing the following 3 transactions simultaneously. Okay. First, you want to sell, okay, $1.5 million and for 1 million pounds, right? So you buy 1 million pounds in New York, okay? 2, simultaneously you sell, okay, 1 million pounds in Geneva for 4 million francs. Okay, and then at the same time in London, you sell 4 million francs for $2 million. Okay, so all of a sudden, you have turned your initial 1.5 million into $2 million. Okay, so you need to do these three transactions simultaneously in these 3 different markets, but you can quickly turn 1.5 million to 2 million if the actual differences are this big, right? So, and by doing this, you have just made $500,000 risk-free as long as you're quick enough, right? So that's a 3-point arbitrage example. Okay, now in reality, the differences in these exchange rates are rarely this big, and so you don't make nearly as much as easily. But if you're good at it and you're fast enough and you have enough funds, then you can still make a healthy profit, right? So even if you make just $10,000 in a transaction, remember this is simultaneous, right? So a few seconds, you make 10 grand. That's not bad, right? So that's what arbitrage is. Okay. All right. Now let's talk about the forward market some more, because that is a big part of the foreign exchange market, and it can tell us a lot of things that we need to talk about for the rest of the chapter. Okay. So this is something that students struggle with. Okay. We'll talk in a second about how the forward market rate is determined. And oftentimes, a common pitfall that students fall for is that they look at the forward rate and then they look at the spot rate, and they think somehow the forward rate is a prediction about the future, right? So let's say if the spot rate, is $1.50 per euro, and the forward rate, let's say the 3 months forward rate, so okay, this is $2 per euro. Okay, a very common mistake people make is they look at this and they say, hey, the market must expect the euro to appreciate or the dollar to depreciate, because currently on the spot it's $1.50 per euro. The forward for 3 months from now is $2 per euro. So that must be some kind of market prediction about what is about to happen. Wrong. Okay, just get that out of your head. Okay, the forward rate, we'll talk about this more. I'll show you how in just a second, but the forward rate is completely 100% determined by any difference in interest rates in the two countries. Okay, it does not reflect how the market predicts the spot rate is going to go in the future. I'll say that again. The forward rate, the only thing that determines the forward interest rate, sorry, not interest rate, the forward exchange rate between two currencies is the difference between the interest rates in the two countries. Okay, and it does not have anything to do with market predictions. Okay, so get that out of your head now, and don't think somehow this is a prediction. Okay, I'll show you exactly how it works in just a second. Okay, but before we do that, okay, let me introduce a couple of concepts. Okay, so if a foreign currency is worth more in the foreign market than the spot market, like the numbers here, right here, the foreign currency is the euro. The euro is clearly worth more in the forward market than the spot market. We call that a premium. Okay, we say that there's a forward premium, meaning that the foreign currency is worth more in the forward market than the spot market. Okay, if the foreign currency is worth less in the forward market than the spot market, we call that a discount. Okay, and the way to calculate your how big your premium or discount is. Okay, so the premium, or I guess discount, okay, is your forward rate minus the spot rate, okay, divided by the spot rate, okay, times 12 divided by the number of months forward. Okay, so let me give you an example. Okay, just using the numbers we have up there. So given the spot rate to be $1.50 per euro, and in the 3-month forward market is $2 per euro, then we can calculate what the premium equals to, right? It's the forward rate of $2 per euro minus the spot rate of $1.50 per euro divided by $1.50 per euro of the spot rate times 12 divided by, this is a 3-month forward contract, okay? So then this tells you it is 50 cents divided by $1.50 times 4, okay? So, and this gives you, okay, roughly, let's see, get my calculator to give you a precise number, not the rough number. Okay, so you have 0.5 divided by 1.5 times 4. Okay, so you have 1.33. Okay, and or another word. Okay, this is 133% of a premium. Okay, so or 133% of a premium. Okay, so if it's a negative number, it'll be a discount. Okay, if it's a positive number, it is your premium. Okay, so now what does this mean? Okay, the premium means your forward rate, okay, on an annual basis is going to be 133% higher than your spot rate, okay? Because remember here, this difference is based on 3 months. So when you do the 12 divided by 3 months, then you convert it to an annual difference. That's why it seems bigger now than just the difference between 2 and 1.5, okay? Now, this simply just tells you what is going on between the forward rate and spot rate, but like I said, the forward rate is determined solely by the difference of your interest rates in the two countries. So how does that work? Okay, well, let's look at an example, right? So let's say that in the UK, okay, in the United Kingdom, you have higher interest rates than the US. So UK, let's say, I don't know, they have, let's say they have a 3% return on their 3 month bond, and the US only has a 1% return on their 3 month bond. Okay, if that's the case, okay, US investors will put money in the UK instead of the US, right? So what's going to happen is that US investors, okay, will buy pounds right now, okay, in the spot market, okay, and then they'll sell pounds in the forward market because they want to exchange their money from pounds back into dollars 3 months from now, right? So that's what they're going to do, okay? Well, when they buy pounds from the spot market, okay, that is going to raise the spot price for pounds. Oops. Spot price for pounds. Okay, that will increase, but when they sell pounds in the forward market, okay, then there's going to drop, this is going to drop the forward price for pound. And so that means then the pound will move to a discount in the forward market, right? So you will have, so pound moves to a discount. Okay, so on the other hand, if the US offers higher interest rate than the UK, so this is interest rate for investment. Okay, if the US has higher interest rate than the UK, then you would see the opposite happen, and that's when you have a premium. So given the example we just did here, where you have a 133% premium, that means the US is offering much higher interest rates than Europe is offering, the Eurozone is offering, okay? But nonetheless, this is how, okay, so this graph, I mean, not graph, this little chart here is showing you how interest rate differentials are driving the forward rate, and this is the only thing then that drives the forward rate. So don't think the forward rate is somehow a prediction of what's about to happen to the spot rate. Okay, all right. Okay, now, excuse me. So this, okay, is assuming that first of all, people participate in investment across the globe, which they do, okay? But also, excuse me, if you want to invest in foreign countries, okay, and the reason people sign these forward contracts is to hedge against risks. What I mean by that is, well, you don't have to sign a forward contract. If you want to take advantage of the difference in the US and UK exchange rates, in this example, you can say, okay, now I'm just going to buy pounds in the spot market, buy UK bonds, then I'm going to wait for 3 months and then sell the UK, get my pounds in from the UK bonds and sell my pounds and convert them back to dollars and make the higher return. Now, this assumption will only work if the spot rate doesn't change or somehow changes in your favor, right? But let's say in three months, if the pound actually, the spot rate significantly depreciated, right? The pound just depreciated, then that 2% um, extra interest you just made might not be enough even to cover the depreciation. If the dollar depreciates more than 2%, then you would have lost money. So that's why, okay, people are willing to sign a forward contract now, even with a discount. Let's say the discount is 1%, then that means they can still make a 1% profit because the interest rate difference in this case is 2%, right? So by investing in the UK, you can make 2% more money, more return, and you can then sign a contract, a forward contract now at a 1% discount. You take a hit. At the end, you still make 1% extra than you would in the US by going through with this deal. So that's why people do this, right? And this is called interest arbitrage, okay, when people try to take advantage of the difference in interest rates. And when you only do the interest arbitrage in the spot market, where you buy pounds now and then you worry about selling pounds later when you get paid in pounds, that's called uncovered interest arbitrage. And the risk is that, for example, right here in this example, the risk is if the pound depreciates more than the interest rate difference here. If the pound depreciates more than 2%, you will lose money, right? So when you sign a forward contract, that's called a covered interest arbitrage, and that reduces your currency risk, right? Sure that the pound could very well appreciate due to some other factor, but you don't know that, right? So to protect yourself, you take advantage of the 2% interest rate difference here, and then you sign a contract, forward contract at a 1% discount, and you will still make a 1% higher return in the UK than the US. Okay, so your book has a couple examples with numbers. You can look at those. It's pretty easy to understand, and I hope that even with this little example, you've understood what I'm talking about. Okay, all right. Now, so that is the difference between arbitrage and hedging and interest rate arbitrage. And one last thing you can do with the foreign exchange market is called speculation. Okay, so speculation is an attempt to profit by trading on expectations about prices in the future. Okay, so that requires you to have some kind of deliberate assumption of the exchange rate risk, where you say, I am going to buy a bunch of pounds, and I am sure in 3 months pounds are going to appreciate, so I'm going to sell pounds then and make money. Right? Remember, arbitrage requires you to have simultaneous transactions to make a profit. Okay, and hedging is when you sign a forward contract to eliminate future risks. But speculation is when you say, I am just gonna trust my guts or my own analysis, where I am gonna do something now and wait till the exchange rate changes and then sell or buy something different, and because I am counting on the exchange rate, the spot rate changing in my favor in the future. Okay, so when it comes to speculation, there are two ways you can do things. Okay, one is you can take what's called the long position. Okay, the long position is easy to understand. Okay, this is when you buy low and sell high. Okay, you do this when you expect a currency to appreciate, right? So if you expect the pound to appreciate in 6 months, you can buy the pound now, wait till it appreciates, and then sell the pounds, and then you'll make more dollars back. Okay, that's a long position. I think most of us understand that pretty well. But you can also hold what's called the short position. Okay, the short position is when you sell high now and then buy low later. Okay, now you might say, well, wait a second, how does that work? Okay, so the short position works when you expect a currency to depreciate. And what you're going to do is that you borrow, okay, you borrow money to make this happen. Okay, excuse me. So let's say that currently, okay, it is, oops, it is, let's say, $1.20 per pound. Okay, that's the current spot rate. Okay, and you expect in the future, okay, future spot rate. You expect, I should say, maybe expected future spot rate, right? Because you don't know for sure. But you expect in the future the pound is going to depreciate, so it's only going to cost you $1 per pound. Okay. Then what you can do now is you can go to a currency broker and say, hey, how about I borrow 1 million pounds right now, okay? And let's see. Yeah, so let me think this through. Okay, so yeah, that's right. So how about I borrow 1 million pounds from you right now, okay? And I agree to pay you a fee or whatever you agree to be the cost. And then what you can do is you can sell the 1 million pounds right now and you get $1.2 million in the spot market right now, okay? And then let's say your expectation actually comes true. The pound does depreciate. So in the future, what you'll do is you will spend $1 million to get 1 million pounds once the exchange rate, you know, and once the exchange rate goes according to you expected, the pound does depreciate. Then you can pay this 1 million pounds back, okay? But remember, you made 1.2 million off of this, and you only used 1 million to buy the pounds that you need to pay back, so you have just made $200,000 in this transaction. Okay, now minus whatever fee you agree to pay the broker. Okay, so if you expect a currency to depreciate, you can always hold a short position by selling high and buying low later, but you don't use your own resources, right? And you borrow the foreign currency from somebody else. And similarly, you can hold a short position in the stock market, where you go to a broker, borrow their stocks when you think the stock is going to crash, right? So you borrow it now, sell it at a high price, make a lot of money, wait till that stock crashes, buy the same number of shares back with fewer dollars, give the stocks back to the broker, you keep the difference, right? Because you sold for a lot more money than what you needed to spend to buy it back, right? So that's called a short position. Okay. Now, when it comes to speculation, okay, there are also two types of speculations in terms of what it does to a currency. Okay. You can have what's called stabilizing speculation. That's when you work against the market forces by moderating or reversing the rise or fall in the currency's exchange rate. Okay, it's very useful for bankers and businesses that want to stabilize an exchange rate. If you want to stabilize an exchange rate, then and you have lots and lots of funds to do that, you can work against the market and stabilize it with speculation. But you also can do destabilizing speculation. That's when you amplify and reinforce fluctuations in the currency's exchange rate. And that can be very disruptive to international transactions and investment. But if you do it right, of course, you can make a lot of money, right? If you guess right which way the market is going to go and you push it even harder. And so George Soros, many of you might have heard of this name before, is a big financial tycoon on Wall Street. And he's made his hundreds of billions of dollars by shorting a lot of currencies and destabilizing a lot of currencies, smaller currencies in his career. He successfully destroyed, several times small currencies and to a profit. And the most famous one is in 1997. He kind of ambushed the Thai baht and uh, caused the Thai baht to collapse very rapidly, and then started a chain reaction to cause this really big financial crisis in Asia. I started a chain reaction of Asian currencies just being trashed in a very rapidly evolving manner. So anyway, I remember that very well because I lived through that, and most of Asia was in great financial pain because of what he did. But he walked away with billions and billions in profit, right? So anyway, so all these are ways um, you can operate um, in the exchange rate I mean in the foreign exchange market. Now, um, there are people who do this for a career, but it's very difficult to be very successful at this. Only about 15% of day traders can actually make money. So with your, 10 grand you've saved up, it's very difficult to actually make money. The people who make money are the ones that are professionals working for large banks with millions and even hundreds of millions of dollars of assets at their disposal, and they also stay up pretty much all night to watch other markets, right? You have the ones that, specialize in different markets, and if you specialize in the Asian market, then that means you sleep during the day and work through the night. But those are the ones that are more profitable and more successful, and you can get compensated very well. But anyway, so that's chapter 11. A lot of information, like I said. Hopefully, it makes sense, and I hope you write things down if you have questions about them, and we will talk about those on Wednesday. Okay? All right. Have a great rest of your weekend.